Hi everyone, today we'll be going over accounts, May-June 2022, paper 2-1, question number 1. This is structured paper 2, which consists 4 questions, 2 of 30 marks and 2 of 15 marks, and we are also given a time limit of 1 hour 30 minutes. And since question number 1 is of 30 marks, we will be attempting to solve this question under 30 minutes. So without any further delay, let's get started. Kin is a retailer. The following balances have been extracted from his books of account at 31st January 2022. So this is our closing date and we are given the information. We are also given additional information. So let's have a look at those. The first one is that the closing inventory was valued at 13,480 and then no record had been made of goods taken for own use by Kin. So goods taken for own use is basically drawings, right? So drawings amounted to 910, but this had not been recorded. So whenever we're talking about drawings, then this value should be deducted from the purchases and this value should be included in our drawings, right? So drawings now will have the value of 910 and we need to reduce this balance from the purchases. So let's have a look. We have our purchases right here and this amounted to 118,220. So now we just need to reduce our drawings of 910. So that's minus 910. This results in our purchases value to be 118,220 minus 910, which results in the value of 117,310. Okay. Then we are told that an irrecoverable debt of 380 is to be written off. So whenever we're talking about irrecoverable debt, it is associated to our trade receivables, which means that this value of 380 should be reduced from the trade receivables as well. So we have our trade receivables right here, and this amounted to 15,580. So we're just going to subtract 380. And this results in the value for our new trade receivables to be 15,580 minus 380, which is 15,200. Okay, then we are told that the provision for doubtful debts is to be maintained at 5% of trade receivables. So we already figured out the value for trade receivables to be 15,200, which means that we can easily figure out our provision for doubtful debts. Let's figure it out. And we are told that the provision is to be maintained at 5% of trade receivables. So let's write down our value of trade receivables, which is 15,200. And then we can just multiply it with our 5%, which we can write down as 0.05. And this gives our provision for doubtful debts to be 760. Okay, so let's have a look if we are given the opening provision for doubtful debts. It's given right here at the date of 1st February 2021. Because since our closing date is 31st January 2022, this will be the opening date. And we can see that the value of provision at the opening date is 840, but the value at the closing date for provision is 760, which means that the provision has definitely decreased, right? And this decrement in the provision for doubtful debts is always an income. So let's figure out the decrement. So decrease in provision for doubtful debts. That's just the difference between the opening and the closing values. So that's 840 for the opening date minus 760 for the closing date, which results in our decrement in the provision for doubtful debts to be 80. Okay, then advertising includes a payment of 3,250 for a campaign which will last from 1st December 2021 to 30 April 2022. Okay, so let's figure out the month. That's just going to be December, January, February, March, April. But we can see that our closing date is 31st January 2022. So our closing date is right here. And if we're talking about our income statement, then the advertising should only include the value for these 2 months rather than all 5 months. So let's adjust this value. Advertising. Let's look for its original value. We have advertising right here and it had the value of 4,900. Let's write it down. So that's 4,900 and we do not need to include all the payments for 5 months. So let's deduct that. That's minus 3,250. But since these 2 months fall in our current accounting period, we need to include the payment for these 2 months, right? So let's include it. That's plus 3,250. But since this is the payment for 5 months, we only need to include it for 2 months. So we can just multiply it with 2 divided by 5, right? So this gives the actual advertising payment for this particular accounting period to be 4,900 minus 3,250 plus 3,250 times 2 by 5, which results in the value of 2,950. Alright, then rent receivable is 500 per month. So this is rent receivable, right? So let's figure out our total rent received for this particular accounting period. And we have the accounting period of 12 months, right? So if we were to receive 500 per month for 12 months, that just would be 500 times 12. And the total rent received in this particular accounting period would be 6,000. Then wages 1,440 are outstanding, which means that these amount for wages are yet to be paid, which needs to be adjusted. So let's have a look above. We can see our wages and salaries right here, which amounted to 34,640, and we just need to add the outstanding amount as well. So that's plus 1,440, which results in the total wages and salaries to be 36,080. Okay, then Hin sold his business's only delivery vehicle in January 2022, resulting in the loss of 1,350 shown in the balances at 31st January 2022. So this is the loss on disposal. Then we're given business's depreciation policy. For premises, it is to be depreciated by 2% per annum using the straight line method, which means that this depreciation rate is to be applied to our cost rather than the net book value. Let's figure out the depreciation on premises. So that's just 2% of cost, right? So 0.02 times the cost of premises. Let's have a look above. So we're given the premises at cost right here, which amounted to 360,000. Let's write it down. And this gives our depreciation premises for this particular accounting period to be 0.02 times 360,000, which results in the value of 7,200. Similarly, let's figure out our depreciation on furniture and equipment. And we are told that furniture and equipment is to be depreciated by 15% using the reducing balance method, which means that this depreciation rate is to be applied to our net book value rather than the cost. So that's 15%, 0.15 times the net book value. And we know that net book value is just the difference between the cost and our accumulated depreciation. Let's have a look above. So, okay. We can see our furniture and equipment at cost has the value of 18,900, and the furniture and equipment provision for depreciation or the accumulated depreciation amounts to 7,300. So let's substitute these two values in order to figure out the net book value. So that's cost of 18,900 minus accumulated depreciation of 7,300. And this gives the depreciation on furniture and equipment for this accounting period to be 0.15 times 18,900 minus 7,300, which results in the value of 1,740. Okay, I think this concludes all of our additional information. Now, for the first part of this question, we need to prepare the income statement for the year ended 31st January 2022 and use the space provided for your workings. Alright, so I've already done all of my workings above and scribbled all over the question paper, but instead of doing workings on that page, you need to show all of your workings on page 4. Okay, so let's start our income statement. So whenever we're talking about income statement, we always start with our revenue. And we've adjusted all of our additional information, right? So we only have to look for the values and then substitute those values into our income statement now. Let's have a look above for the value of revenue. And we're given revenue right here, which amounted to 197,300. Let's substitute this value. Then we can move towards our cost of sales. And the first item to be included in cost of sales is our opening inventory. Let's have a look above. Okay, we are given inventory at 1st February 2021, which is our opening date, to be 12,310. Let's substitute this value into our income statement. That is 12,310. Then the next item is to add the purchases. And we already adjusted our drawings to the purchases. So let's have a look for its value. We are given purchases right here, and we adjusted and figured out the value to be included in the income statement to be 117,310. Let's substitute this value. That's 117,310. Then let's have a look to see if we are given any carriage inwards. Okay, we can see that our carriage inwards is given, and this amounts to 2,140. Let's include this as well. And carriage inwards is our cost, right? So we need to add it to our cost of sales as well. So let's add carriage inwards, which amounted to 2,140. And then finally, we need to subtract our closing inventory. Let's have a look above. Closing inventory is given in additional information right here. And it was valued at 13,480. Let's substitute this value. So that's 13,480, which needs to be subtracted. And this concludes our cost of sales. So now we can figure out the total for cost of sales, which is just the sum of these four values. That's 12,310 plus 117,310 plus 2,140 minus 13,480, which results in our total cost of sales to have the value of 118,280. And since we need to subtract the cost of sales from revenue, I'm just going to put it in a bracket as well. Now we can easily figure out our gross profit. That is just the difference between revenue and cost of sales, which is 197,300 minus 118,280, which results in our gross profit to have the value of 79,020. Okay, then we know that there were few incomes. We were given the decrement in our provision for doubtful debts, which is definitely an income, right? So we need to add all of our incomes to the gross profit. And the first one is the decrease in provision for doubtful debts. We've already figured out its value, so let's have a look above. Oh, right here. So decrease in provision for doubtful debts amounted to 80. Let's write it down. And then our next income would be that of rent, right? Because we already calculated the rent received for this particular year as well. Let's have a look above. So rent received, we calculated it right here to be 6,000. So let's substitute this value into our income statement. So let's see if we have any other incomes. So, okay, that concludes all of our incomes. Let's figure out the total for the incomes. That is just going to be the sum of these two values. So 80 plus 6,000, which results in the value of 6,080. Now we can move towards subtracting all of our overheads. Let's have a look above. Okay, the first one is advertising, and we are given additional information regarding advertising, which we adjusted and already figured out the value to be included in our income statement right here. So advertising, we figured it out to be 2,950. Let's substitute this value. And this amounted to 2,950. Let's have a look above. Then we are given carriage outwards, which is again an expense, right? So this needs to be included in our overhead section. This amounted to 1,730. Let's include this. So that's carriage outwards with the value of 1,730. Let's have a look above. Then we are given furniture, so we definitely need to include our depreciation on furniture as well, which we already figured out right here. So depreciation on furniture and equipment amounted to 1,740. Let's include this as well. Depreciation on furniture and equipment. And we figured it out to be 1,740. Okay. Then we're given general expenses with the amount of 13,450. This is an overhead, so let's include this in our income statement. That is general expenses with the value of 13,450. Let's have a look above. Then we are given our irrecoverable debts. Okay, then we're given also another irrecoverable debt in our information right here. An irrecoverable debt of 380. So we need to add this as well. So that's 670 plus 380, which results in the total irrecoverable debts to be included in our income statement to have the value of 1,050. Let's include this. That's irrecoverable debt of 1,050. Okay, let's have a look again. Then we have our loss on disposal of delivery vehicle amounting to 1,350. Again, this is something to be included in our overhead section. Let's do that. So that's loss on disposal of delivery vehicle with the value of 1,350. Let's have a look above again. Then we are given premises, and we need to apply our depreciation to premises as well, which is an overhead, right? So let's include our depreciation on premises as well. We already calculated it to be 7,200. Let's include this value. That's depreciation on premises with the value of 7,200. Okay, let's have a look above again. Then we have the provision for doubtful debts, which we already included as an income. We already included the purchases. We already included the rent received, revenue as well. We included our trade receivables in the form of irrecoverable debts, right? Then finally, we have our wages and salaries, and we already adjusted our outstanding wages and figured out the total to be included in the income statement to be 36,080. Let's include this. So that's wages and salaries with the value of 36,080. And this concludes all of our overheads. So let's figure out the total. That is just going to be the sum of these 8 values. So that's 2,950 plus 1,730 plus 1,740 plus 13,450 plus 1,050 plus 1,350 plus 7,200 plus 36,080, which results in the total overheads to have the value of 65,550. And since our overheads need to be subtracted, I'm just going to put it in a bracket. Now we can easily figure out the profit for the year. That is just going to be gross profit plus income minus overheads. So in this case, that's 79,020 plus 6,080 minus 65,550, which results in our profit for the year to have the value of 19,550. And this concludes our income statement as well as the first part of this question. So now we can move towards the second one. Alright, like I said before, instead of scribbling over the question papers like I did, you guys need to be showing all of your workings in this particular box. Now we are given additional information. There was no opening balance on the rent receivable account at 1st February 2021. Now, for the second part, we need to prepare the rent receivable account for the year ended 31st January 2022. Since there was no opening balance, we can start with the amount that we included in our income statement as rent received. Let's write it down. And since rent received was an income, our income statement will be on the debit side on our rent receivable account. So that's income statement. Let's have a look above to see the value that we included as our rent received, which is right here, and that value amounted to 6,000. So let's include this in our rent receivable account. And we're also given the total rent receivables in the above information. It's right here. So rent receivable, this amounted to 7,000. And this definitely needs to be included in our rent receivable account, right? And this will go towards the credit side under the heading of bank. Let's write it down. So that's bank with 7,000. So this is the total of the rent receivables, and for this particular year we received 6,000, right? So the remaining amount is still our rent receivable value, and that will act as our closing value for the rent receivable account. Let's figure it out. So the total is definitely that of the heavier side, which is 7,000, which means that our closing value or closing balance will be on the debit side. That's balance CD. And whenever we're trying to figure out the balancing figure, we just need to subtract this amount from our total. In this case, that's 7,000 minus 6,000, which results in the value of 1,000. And now this closing balance will act as the opening balance for the next accounting period, right? So that's balance BD with the same amount of 1,000. This concludes the second part of this question. Now we can move towards the third one. We now need to prepare a journal entry to record the adjustment to the provision for doubtful debts account at 31st January 2022. So at 31st January 2022, we just compare our opening provision to that with the closing provision and figure out whether there is an increase or a decrease, right? And in this particular case, we figured out that there was a decrease in the provision for doubtful debts, which acted as an income to our income statement, right? So since we recorded this decrement in the provision for doubtful debts as an income in the income statement will be represented in our journal on the credit side as the income received, right? Let's write it down. So that's income statement. And let's figure out the value that we included as our income. Okay, it's right here. That's decrease in provision for doubtful debts with the amount of 80, right? We need to include this value in our journal as well. So that's 80. And this value in the income statement actually arises from our provision for doubtful debts, which will be the account to be debited in our journal. So that's provision for doubtful debts with the value of 80 as well. And since a narrative which is not required, this concludes the third part of this question. Now we can move towards the fourth one. We are given additional information. Kin intends to purchase a new delivery vehicle. He is not sure whether the delivery vehicle should be depreciated using the straight line method or the reducing balance method of depreciation. And for the fourth part of this question, we need to explain the reason for recording depreciation in a business's income statement. So we can categorize depreciation under our matching concept, right? Because matching concept states that we need to match our costs and revenues for an accounting period and figure out whether there is a profit or loss, irrespective of actual receipts and payments, which means that it also incorporates our accrual concept. It does not care whether our receipts has been received yet or not and our payments have been made yet or not, but we include that as our payments or receipts for this particular accounting period, right? So we could categorize depreciation or the reason for recording depreciation under our matching concept as well. Let's write it down. To apply the matching concept, so that profits are based on matching costs and revenues for an accounting period irrespective of actual receipts or payments. So basically, depreciation is recorded just to divide the cost of purchase of that particular non-current asset over the years of its useful life, right? And in this case as well, as we can see that in order to apply matching concept, we need to match our costs and revenues. And this depreciation actually acts as in cost, right? Because we are essentially categorizing this depreciation as the cost incurred for the uses of the non-current assets for this accounting period. And there is irrespective of actual receipts and payments, right? Because in this case, whenever we're purchasing non-current assets, we already make the entire payment while purchasing it, right? But in case of depreciation, we're just categorizing the cost among various years. So we're not actually paying that amount in this particular accounting period, but despite that fact, we categorize this as a cost for this particular period. Alright, this concludes the fourth part of this question. Now we can move towards the fifth one. We need to state one benefit of using each of the following methods of depreciation. And the first one is straight line method of depreciation. Under this method, we just need to apply our rate to our cost. So there is no lengthier process in order to figure out the net book value, right? So this is a pretty straightforward to apply or calculate. Let's write it down. Straightforward to apply or calculate. Then for the second part, we need to state one benefit of using the reducing balance method of depreciation. And in case of reducing balance, we apply our depreciation rate to the net book value rather than the cost. And this allows us to represent the actual uses of non-current assets. Let's write it down. May correspond to actual uses of non-current assets. Alright, this concludes the fifth part of this question. Now we can move towards the sixth one. We are again given additional information. Kin is concerned about a decline in the business's profitability, and he is considering two options. So option one is to decrease the amount spent on advertising whilst also reducing the selling price by a small amount. And then option two would be to purchase goods from cheaper suppliers. Now for the sixth part of this question, we need to advise Kin which option he should choose, and we need to justify our advice by discussing both options. Okay, so let's discuss option one first. Under option one, we are suggesting to decrease our spending on advertising as well as reducing the selling price, right? So this will definitely reduce the cost and increase the profits, right? Because there is reduction in overheads and expenses. Let's write it down. Will reduce costs and increase profits. And since we're talking about reducing our advertising, that could possibly reduce demand as well, because if our advertising is successful and that is grabbing the attention of potential customers, then the reduction in advertising would reduce or lose those potential customers as well, right? Let's write it down. May reduce demand if advertising had been successful. Okay, then we are also told that we are reducing the selling price. So if there is a reduction in selling price, then maybe that could increase the demand, because as comparing to our competitors, maybe our customers will find our products cheaper and would rather buy from our store rather than the competitor's store, right? And that could definitely increase the revenue and as well as the profit. Let's write it down. Reducing selling price may stimulate demand and therefore increase turnover and profits. Okay, now let's move towards discussing option 2. And under option 2, we need to purchase goods from cheaper supplier. Again, if we're purchasing from a cheaper supplier, that would reduce our cost of sales, which would reduce the total cost as well as increase the profits. Let's write it down. Will increase profits and reduce costs. But since we're talking about a cheaper supplier, maybe the goods can be of poorer quality, which could reduce demand as well as the profits. Let's write it down. May reduce demand and profits if goods are of poorer quality. And we're talking about switching to a new cheaper supplier, right? So we do not know whether the new supplier will be reliable or not. So that is still a question. Let's write it down. Will the new suppliers prove to be reliable? Now, based on these factors, we need to advise Kin which option he should choose. So in option 2, we're talking about a new supplier, and we do not know whether the new supplier is reliable and whether his goods are of better quality or not, right? That could possibly result in a loss of demand as well as loss of customer base, and that is a risk, right? So I would suggest Kin to avoid that risk and go with option 1. Let's write our decision clearly. Kin should choose option 1. Alright, this concludes the 6th part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.